I welcome everyone to our Friday meeting on COVID-19 economic crisis organized by the Department of Economic Statistics of the University of Naples Federico II. Professor Marco Pagano will introduce the speaker of today, Josef Zechner, Professor of Finance and Investment at the Vienna University. Before giving Marco the floor, let me remind you that all of you have the microphone muted, but you can send your question in the chat. At the end of the talk, I will ask you personally to ask the question to Professor Zechner, opening your mic. So Marco, the floor is yours.
Thank you, Saverio. Well, let me thank Josef a lot for accepting our invitation to participate to this series of web-based seminars on COVID-19. And well, Josef is one of the best finance professors in Europe, so it is a great honor for all of us to be able to hear his lessons about finance and COVID-19. So without any further ado, I give the floor to Josef. Thanks.
Thank you very much, Marco and Saverio, for inviting me and giving me the opportunity to present in this series. So I thought I would talk a little bit about my view on the effects of COVID-19 on the investor side, as well as on the corporate finance side. So both on the demand side of corporate securities, which is the investor side, and the supply side, which is the corporate side. And there I would like to talk about dividend policy and corporate bond issuance during the ongoing crisis. And I will mostly talk about two ongoing projects that I have with some co-authors on these two topics. So what was the reaction of investors to the COVID crisis? How did the major asset classes respond to the pandemic? And here on this slide, you see the revaluation that happened in all the major asset classes. These are expressed in euros between the end of last year and the first week of April. So you can see that a European investor essentially suffered quite severe losses on all the major asset classes. Even an index of euro-denominated sovereign bonds, which is the second asset class here, overall had at most a zero performance until then. And then as you go into the more risky asset classes, like corporate bonds and then high yield bonds, which by definition are not investment grade, or emerging market bonds, the losses increased. And then the equities are the blue bars here. They all were down around 20 or even more % since December, and even more if you calculate the drawdown from the various peaks. And you see Europe is again a little bit worse than all the other three areas, such as North America, Pacific, and emerging markets. And the most heavily hit asset class was commodities, where, as we all saw, we in addition to the market turmoil, we had the price war between Russia and Saudi Arabia, which seriously depressed the oil prices on top. At the same time, what we call market sentiment also crashed. Market sentiment, this actually is a sentiment index that is calculated by an Austrian asset management company, Spengler Equam Invest, which I do some advisory work for. And essentially what you see here is the sentiment indices for the three main areas, geographic areas, the US, the Europe in blue, and Pacific in light green. And what that is essentially it's the first, it condenses the information from a number of inputs. It's what we call the first principal component from the implied volatility of index put options. So how expensive is it to buy insurance against a market drop? How much trading is happening at the market? How different is the valuation of risky stocks versus less risky, measured by their idiosyncratic volatility. So if you take out market volatility, and then there's also survey data such as the purchasing manager indices entering. And you can see that almost all the time these sentiment is between +1 and -1, but and actually until recently for the US we were at very high levels, which means a very positive attitude of the market to risk. But now this is actually only until the end of March, and you can see for Europe, for example, we already in the -1 no, sorry, we are already, the blue line also is Europe is below -1, and now since then, since the first week of April, this dropped even further. So what does this tell us about the markets or the investors' expectations about future cash flows, and what does it tell us about discount rates that they require? What does it tell us about risk premia that investors seem to require? And to answer or shed light on this question, we can utilize data from dividend futures. Dividend futures are traded both in North America and in Europe, and they essentially give you a bet on the pure dividend component of an index or on an individual stock. And they are traded for different maturities. So a dividend futures 2022 is a bet on the annual dividends that are paid either by the S&P 500 or by the Euro Stoxx 50. Yeah. And we can observe those futures, those dividend futures, with maturities up to 10 years. So the last one is traded for the year 2030, so 10 years from now. And the nice thing is that a futures price, if markets operate properly, a futures price is the risk-adjusted expected value of this instrument, of the underlying. And so all we have to do is take the futures prices and discount them at the risk-free rate. And because the risk-free rate is really zero for maturities out to 10 years, we can probably even forget about the discounting. But we can simply add up the futures, the dividend futures from now to 2030, and we have the present value of what the market thinks the dividends are worth over the next 10 years of dividends are worth today. And if you did this just before the onset of the crisis, those dividends, the present value of those dividends from now to 2030, so 2021, 2022, and so on, would have made up about 20%, a little bit more than 20% the stock prices of the S&P 500 or the Euro Stoxx 50. Yeah. And now we see that today was a very positive day. So today we saw another rebound a little bit, but still most the S&P 500 and the Euro Stoxx 50 are still almost 20% below their highs before the crisis. And so let's do a little thought experiment. Let's assume that the crisis today has no effect on expectations about dividends beyond 2030. So let's assume that even as severe as this crisis might be, as we get to 2031, we're probably not going to change much what we think the market would look like then, even with and without COVID-19. I agree this is an assumption, but it's an arguable assumption. And let's for the moment assume that the market's expected risk premium have not changed either. That the equity holders still require the same risk premium, the same discount rate. In this case, a 20% revaluation would mean that the only way to explain it then would be if investors would think that there's no dividends paid over the next 10 years. And so now we believe that not even the most pessimistic scenarios of this pandemic would predict such a serious effect. And therefore, the conclusion that I draw is that it's not all changes in cash flow expectations. It must also be changes in expected risk premium. It must be changes in discount rates, which have occurred since the crisis. Which the other side of the coin means that if you are now buying into the stock market, the market would be priced more favorable for the long run because on expectation we now earn a slightly higher or a higher risk premium. The question is, why might the risk-bearing capacity be lower now than before the onset of the pandemic? Well, one possible reason would be that the average investor is now poorer because the average investor's portfolio has lost value, and so simply through a wealth effect, we could think that risk aversion has gone up because we are now less willing to gamble on a fraction of our wealth, given that we're already poor. But there are other reasons, more institutional reasons, I think, that have to do with this counter-cyclicality of risk premium. That risk premiums seem to go up in crisis situations. And this is sort of something that also comes out a little bit from my advisory work for the asset manager I mentioned before. Many institutional investors, such as life insurers, pension funds, they actually impose on themselves annual risk budgets. So in January, they would tell their asset managers, okay, here is our portfolio. You can manage our portfolio, but we want you to make sure that the portfolio cannot lose more than a certain amount, more than say 5% or more than 10%. And the way that asset managers implement this constraint is essentially by having this constraint that I wrote down here, that the portfolio value at any point in time t minus this lower bound that the investor imposes on the asset manager, which I call G here, that must be greater than a risk measure that is usually used here is what is usually used here is the value at risk at time t. So the value at risk gives you the maximum loss of a portfolio over a period of time that can only be exceeded with a certain probability, say 1%, 0.5%. And so you can see from here, as the portfolio value moves closer to this bound, to this lower bound, you have to do one thing: you have to reduce the value at risk, and that's the only way to do it is to move from risky assets into less risky assets. And in a way, a crisis hits these strategies from both sides. On the one hand, prices drop first, but volatility also goes up. And so the left-hand side decreases, but the right-hand side, the lower bound, actually goes up. And so today, most of such portfolios have fully exceeded their or used up this risk budget, which means that the portfolios are essentially in money market instruments, in German short-term government bonds, and so on. And so there's very little room for risk taking in a big segment of the institutional investors, and therefore risk premia increase. And a similar idea was sort of formalized nicely in a paper by Markus Brunnermeier and Lasse Petersen in 2007, which emphasizes these liquidity spirals, that this also depresses the risk-bearing capacity of institutions. So what's happening here is a shock to an institution's capital, because maybe through the coronavirus, airline stocks or loan that the bank made to the airline is now worth less because the risk spreads have gone up. So that leads to a loss in this bank's net worth, and because many institutions must have equity relative to their risky assets, they have to get rid of the risky assets. So they have to engage in fire sales that will depress the price further of these assets. And so through this marking to market channel, you might have to do more sales. And this is sort of the outer circle here. And then you also have a volatility effect because prices move and the value at risk or other risk measures have gone up. Therefore, haircuts go up, margin requirements go up. Therefore, funding liquidity goes down. The firms cannot get same amount of funding through the repo market. Banks cannot do that, and that sort of another liquidity spiral. And so both these arguments, I think, can explain why not only cash flows have been downwards revised by the market today, but also the discount rate has gone up, the risk premium. Here's just one graph that shows that which stocks seem to be most affected by this increase in risk premia. Well, we have here for the US the market, which is in blue, and we have a so-called value portfolio, which is a portfolio of stocks which have a high book to market ratio, which means that their market value relative to the book value is low. So those are firms that have a high operating leverage, etc. So they have been more affected than the market. And the black line is the size portfolio, which consists of small cap stocks. So the small firms have also gone down more. You see here the development from the end of last year down to the early April. And the same thing is actually true for the US. Sorry, this was the US, and this is for Europe. This is the MSCI Europe, and again, this is small caps, which I call size, and value, which is these high book to market ratio stocks. And this seems to be a fact that shows up persistently in crisis. So if you look at the great financial crisis in 2008, we see the same phenomena. So here is the US here to the left and Europe to the right, and here I've normalized the values of these portfolios to be the same at the height of the crisis, which was like early in 2009, and you can see that the green line it dropped more, so the value stocks have lost more, and the small stocks have lost more than the market. But then also in the rebound, these stocks are doing a little bit better, and the same thing is true for Europe. Should I stop? Are there any questions, or should we have the discussion at the end?
No, you can go ahead, Joseph, and then we will
Yeah.
take question at the end.
Yeah. Okay. One last point on this part of the agenda is liquid or illiquid assets. Many institutional investors, such as pension funds, life insurers, they have heavily shifted their asset allocation into what we call illiquid asset classes. What are illiquid asset classes? Well, examples are private equity, real estate, private lending, or infrastructure investments, such as gas pipelines or electricity nets and grids and so on. And the motivation was that the investors thought that and probably right so, these asset classes might actually earn them an illiquidity premium, because the market doesn't like illiquidity. So to induce investors to hold illiquid assets, you need to pay a higher return on those investments. But they also like, not only that, they like the fact that they're a little bit harder to value. They don't have an readily observable market value at any day, such as a stock has. And so they don't need to fully necessarily show a drawdown immediately. And there's some flexibility in how they value a private equity portfolio. But I think in times like these asset classes will suffer particularly. We don't have easy data on that, because they don't have, by definition, an observable market price. But private real estate or commercial real estate is suffering quite a bit in Austria, for example, because the government essentially imposed a moratorium that shop owners who are renting their offices and their space, they don't need to pay rent now for some time to come, and even when they have to pay rent, it's not clear that they can. So it's not as safe an asset as they thought it would be, and I think these valuation effects have not fully been recognized by everybody in the market, and eventually they will ripple through, and then those limitations on the risk-taking capacities will even increase. And this reminds me of a famous Warren Buffett quote who said, "Only when the tide goes out do you discover who's been swimming naked." And now when we have this crisis, you might actually see what was hidden in portfolios. So that was a few observations on the investor side. And the second part of my talk, I'm going to talk about the corporation, the corporate side. And I would like to start with some observations about corporate dividend policy. Now, I think everyone in the audience here probably has been going through the Modigliani-Miller irrelevance theorem in their famous 1961 paper, who proved that dividend policy should not matter once you fix investment decisions and capital structure decisions. But the real dividend policy of firms doesn't seem to reflect this irrelevance. Instead, firms seem to place a lot of emphasis on smoothing their dividends. They don't want to drop their dividends even when their earnings drop more. They want to keep sort of a projectable flow of income for their shareholders. So in a way, they may be playing an intermediary role to provide these investors with predictable liquidity. And so what I've, and this is from ongoing work with two colleagues, Georg Zeinek and Otto Randl from Vienna. So what we've done here is we again used dividend futures, and we regressed dividend futures, both the near futures, the 2020 contract and the 2021 contract, we used data from the past few years, and we regressed them on the market. And you can see the betas here, essentially the dividend betas, the cash flow betas, or the dividend exposure, and they are all substantially less than 1, which is very consistent with this notion that dividends are smooth. They are not as volatile as the market. Near dividends are smooth. And so this crisis is a good possibility to see whether this folklore that dividends are so smooth is also true in extreme states, in a crisis. And so we looked at the recent behavior of dividend futures and the market, both for Europe and for the US. So you see here from last May on, the Eurostoxx 50, and the dotted red line is the dividend futures contract for maturity 2021, and the solid red line is the futures contract for 2020. And you can see clearly there's smoothing here. There's much less volatility in the value of those dividend strips or dividend futures than in the overall market, as we expect. But now you can see, well, when COVID started here in March, mid-March, or early March, the market started to go down. Maybe the dividends valuations didn't go down so quickly. It was still resilient, still smoother. But now the dividends were repriced more extremely than the overall market. So you can see that the dividend value is now down to about 50%, or at least that was in the first week of April, 50% of what it was in last year. And the same thing is true here in the US market. So it starts a little later, but then dividends prices are much more severely affected by the crisis than the overall market. So clearly, these betas that I showed you here, they don't tell us the full picture. What we see here is what we call in technical language a negative co-skewness, that the short dividends are near-term dividends are negatively co-skewed with the market. When the market really drops a lot, then the dividend value drops even further. And investors don't like that, of course. So that might explain a puzzle in this market, namely that near futures contracts seemed to earn much too high risk premium. So investors thought this is an anomaly. This is a great investment. Just buy dividend futures and make a nice return with very little risk. But maybe what this is like a peso problem, that you do earn a risk premium, but eventually this risk becomes realized, and then you paying for it. Okay, so that was my observation to dividend policy, and I think it's also a little relevant because there's a lot of policy discussion now. Do you want to restrict dividends? And clearly, I think it's clear if you get government subsidies, you don't want these to be used to be paid out for dividends. But if a company is in a strong position liquidity-wise, you might want to not restrict dividends because this eventually would lead to an increase in the cost of equity going forward. The last point I'm going to make is about the bond issuance activities. And unfortunately, I don't have European data here, but we have reasonably interesting US data. So here, the folklore is that capital market-based funding of corporations seems to freeze in a crisis. And a good example is an article that appeared on March 17th in the Financial Times, which had the heading, "Coronavirus Sell-Off Weighs Heavily on Bond and Equity Issuance, Debt Deals and IPOs on Pause as Health Crisis Jolts Markets." So we were trying to see if this folklore is really correct. And here I'm presenting you some preliminary results from a project that I'm doing together with Michael Halling, who is a professor at the Stockholm School of Economics, and Jin Yu, who is a professor at University of Monash University in Melbourne. And our evidence, and I'd be curious to get some feedback also here. Our evidence is exactly the contrary. So what we have here is the number of bond issues in the US in the first 15 weeks of this year. So week 15 was last week. Now we are in week 16, so we are very up to date here. The blue line is the number of bond issues per week average for last year. So we wanted to take out seasonal effects, so we wanted to see a comparison. You can see when the crisis really started, when President Trump imposed travel restrictions to Europe, it seems very quickly after that, the number of bond issues actually went way up to where it was last year on average, and also where it was before the crisis was serious. The number of bond issues this year was pretty much where it was last year. And this is also true if you look at the size of the issues. So the size has gone up a lot. You see the size here again. The blue line is the average face value, and since most bonds are issued at face value, it's also the number of dollars raised. It was the same as last year until the crisis started, but then obviously those bond issues have become much larger, at least in weeks 12, 13, and 14. Now, what are the conditions that firms are facing, that issuers are facing? And here we see again The blue line is the offering spread average from last year, 2019. And here we see the orange bars are the spreads, the IPO spreads this year. And the gray bars are the historical spreads last year of the same issuers. So we take all the ones that issued in week 15, and they had an average spread up here of a little bit of more than 200 basis points. But the same companies last year, they only paid a little bit more than 100 or 1% spread. So clearly, not surprisingly, credit spreads have gone up a lot, risk has gone up, default risk has gone up, and that is reflected in higher spreads. In terms of maturities, no dramatic effects are here. If anything, I would say that this year's issuers choose slightly longer maturities than last year's. So the gray bar, remember, is again the maturity in years of those issuers in week 15. So those that have issued in week 15, for example, they chose an average Fed maturity of 12 years something, or more than 10 years yet in any case, and last year they chose something less than that. And the same is true here in week 14, the same is true in week 13. Although overall, this year's issues in these weeks are slightly lower in terms of maturities, or similar than last year. But despite the fact that the coupon, the spreads have gone up a lot, the coupon, the overall coupon that these firms pay has not gone up. So again, you see the weeks of this year. So week 15 again was last week. So last week, the historical, the issuers last week, they paid a coupon on their issues of, so here, I don't know what this is, like maybe 2.7%. And last year, those same firms that went to the market last week, they paid a slightly higher coupon rate. And here, it's a little bit reversed. The coupon rate is a little bit higher in week 14 this year than they paid last year, but not dramatically, and still below the average of 2019. And of course, the reason is that the Fed lowered interest rates and introduced programs to reduce interest rates overall. And so despite the higher spread, the coupon rate actually did not go up for these issuers. And the final graph I wanted to show you is one that looks at the size of the issuers. So this is the log sales of the 2020 issuers minus the average log sales of the January-April 2019 issuers. So what we see here is that, and so that means it's a little bit difficult to interpret. A number of 1 here means essentially, because this is the log, difference in logs is like a 1.7 something increase in size. So 170% larger firms than the average last year. And so you can see up to the crisis, the size as measured by sales was pretty much the same. But then the firms that are able to rush to the bond markets immediately once the crisis gets serious are the larger firms. So now it seems to get back down again. But the first ones to feed, if I may use this analogy, were the large guys with high sales, or large sales numbers. Yeah, so this is essentially my last slide. So let me wrap up and then give you a chance to ask questions. So my conclusion is that the revaluations that we have observed in the financial markets are not only due to changes in expected cash flows. Expected cash flows have certainly gone down also. But to a large extent, the changes in valuations have been driven by discount rates, by higher risk premium. And the small companies are typically affected much more severely by such increases in risk premium. There's a flight to quality. Value types are affected more. Yeah, because the other extreme of value firms, I might mention, are growth firms. The value firms have high book-to-market ratios. Growth firms have low book-to-market ratios. So their market value is much bigger than the balance sheet value. So those are the firms that have growth options. And volatile times like the ones we observe now, they don't affect the portfolio of growth options so much, because volatility from basic option pricing, we know volatility is not bad for the value of an option. So they are suffering less. But value firms and small firms suffer particularly. I'm afraid that we have not seen the full repricing, maybe in some cases, because these illiquid assets might still be repriced in the coming weeks. And on the other hand, firms responded by substantially cutting, or at least that's what the expectation is, that that's in the futures prices, that firms will dramatically cut dividends, and that they are raising debt. We don't have evidence so close in real time on bank lending, except for aggregate numbers, and they look also dramatic, that they have increased bank lending. But even the corporate bond market, it doesn't seem to be frozen up. It seems to be used more than last year, for example, and especially by large firms. And so the question I want to leave you with is the following: going forward, how will the markets deal with lower risk-bearing capacities on the one hand, and with all this increased leverage on the other hand? That's so what I'm a little worried about. That's
so, Josef, so really thanks for your terrific presentation. So now we have sort of 10 minutes for some questions from students, but of course also colleagues. Or Marco also. Marco, if you want to say something before we are in the while that we are collecting some questions. Yeah, you are muted. I unmute you. Okay, Marco.
Okay. No, one question. Well, to some extent, you have already said something regarding that. Is what has been the role of central banks in all of this? You know, the reason why we may be seeing this extraordinary issuance of corporate bonds is to take advantage of the deluge of liquidity which is being pushed into markets by the Fed and over here by the ECB. So maybe what is happening is that firms are afraid of subsequent problems that the banks may be experiencing, as it was the case indeed in the previous crisis. And so maybe they're stocking up on liquidity available relatively cheaply from the central bank before possibly their bank lenders starts getting into trouble. I just wanted to hear whether you have any feeling regarding that possible explanation for this.
Yeah, that's a good question. I mean, I think that there's one program in the US that's called the Primary Market Corporate Credit Facility, which allows the Fed together with the Treasury to purchase in the primary market.
Mm-hmm.
But they have fairly strict restrictions, like less than 4 years maturity. And I understand that this is mostly intended for firms who use the proceeds for paying workers' wages, in which case they actually might not even need to pay back for 6 months. That's what I hear. But our sample is not does not have those bonds in it, because we don't have a single bond with a maturity of less than 4 years. But I'm sure there is a big effect on the spreads that all the secondary market activities of the Fed has on valuation levels. So
is the Fed currently buying corporate bonds like the ECB is doing, or just the treasuries?
I think the Fed is not allowed to buy corporate bonds. That's what I understand directly. They have these SUVs, these SPVs, as special purpose vehicles, where the government must pay in capital, right? And then the Fed can do lending, and then they can buy corporate bonds, these special purpose vehicles. But my understanding is that the Fed is much more restricted in what it is allowed to buy than the ECB. Okay. So they can only do it indirectly through these special purpose vehicles, and only if the government has put in, I think if the government puts in 10 billion, the Fed can lever up to by 90 or something.
Okay.
Okay, thank you, Marco. Now we have another question from one of our colleagues, Professor Popolo. A second that I open the mic. I should search a second in the participant list. Okay. So Giovanni, now you are unmuted. You can ask your question.
Thank you, Saverio, and thank you, Josef, for your very clear presentation. Just curious about your view again about safe asset. What is safe in this scenario, or at least I would say the most uncorrelated asset with this global shock? I'm curious about that because at some point you showed the behavior of some, say, some funds towards these alternative asset classes.
Yeah.
And so if you can argument also about, you know, safe securities.
Yeah, I'm not sure if I have really much to say. I think Marco is probably the expert to talk more about how to create safe assets. But what we've seen, I think, when the crisis was very intense, that every asset was dropping in value, because the only thing investors wanted was cash. They were selling also the liquid assets, right? What they like gold or even German government bonds, right? So gold dropped on those very severe market stress days. And so it's not. I think the only safe asset is cash. that's my naive view, but of course that might be the consequence of very short-term liquidity needs, and in the longer term you probably go back to German government bonds and US government bonds.
Okay, thank you very much.
So we have another question from another colleague of us, Professor Lorenzo Pandolfi. Lorenzo, now you can talk.
Hi. Hi.
Hello.
Hi. Josef, thank you for the very nice presentation. It was very, very, it will be the effect markets. Because, you know, there could be income. For instance, one can be a lot of investors that basically, which might increase and might also have a negative effect on firms, or the other way around, in some cases, move emerging markets. So I would think with the effect on the emerging markets in general. Thank you.
Yeah, I mean, the most important question that I would see is how does the pandemic, how is that going to play out in these countries? And so far, we have not seen terrible development yet. But of course, if this would happen, then this would be the mega problem given the poor state of the healthcare system that they have. And then of course we probably need to distinguish between different types of emerging markets. If you are exporting raw materials, then that hit you a lot. I mean, if you look at the price effect, the immediate price effect, it was not as bad as you would have expected, right? It actually, emerging market equities suffered by the chart I've shown you up here. Here. It was well. It was at least less than what Europe went down. Yeah. So
yeah. I was asking this because just to say that I was asking because in principle, if international investors are leaving emerging markets for some reason, the effect could be ambiguous in the sense that could explain why the effect was not huge, because there could be a positive effect through currency depreciation, for instance, for countries which have not been already hit by the COVID, for instance.
But so, these are all euro returns. These are not in local currency. So currency effects are already taken into account here.
No, I mean for firms, operating countries, depreciation could be somehow, you know, positive. So in emerging markets, that's why I will.
Yeah, that's true. The only counter argument to this is what people tell me is that, for example, in Turkey or in Argentina, most firms do all the international trade in US dollars. And the net benefit of a currency depreciation is not that clear cut to some of those countries at least.
Okay. Yeah. Thank you very much. Thank you.
Marco, do you want to say something? You are muted. I unmute you. Just a second.
There is the additional issue that in some of these countries, firms may also have taken debt in foreign currency.
Yeah.
So depreciation can hit them with a vengeance for that reason.
Yes, yes.
Josef, I mean, I think we have done with this session of question and answer. So let me thank you again for accepting our virtual invitation. We hope to do a personal one very soon, to be the possibility to get you in Naples. And thank you everybody for participating to this event of this evening. Just a last reminder about the next appointment. It will be next Friday. And Antonio Concha, professor of economics at our department, we talk about COVID-19 effects across industries. So thanks to Josef again and to everybody. Bye.
Thank you. Thank you. Good luck. Bye.
Bye. Good luck. Ciao.